Please start.
Morning, everybody. Thanks for joining on this wonderful Saturday. Uh, as usual, we are having our webinar on this Saturday on a very interesting topic, which will be covered by Mr. Dr. Nirmal Singh. In BBA, we are trying to uh, bring to you all different type of perception, different type of topics, so that we have a expansion of our knowledge base, and that is why we are obliged to Dr. Nirmal Singh that he has taken time out of his busy schedule and joining with us. Also, I would like to inform the members that we are soon having the next week. We are having our Chennai session and a physical session. Do join us with for that event also. Now I'll ask Maithili to give a warm welcome to Dr. Nirmal Singh. Thank you.
Good morning, all. It gives me great pleasure in introducing our speaker for the day, Dr. Nirmal Singh. Dr. Nirmal Singh is an assistant professor of economics at Ramaya University of Applied Sciences. He holds PhD in economics from IIT Roorkee, where he contributed to research on banking market structure, banking stability, income diversification, and institutional economics. Dr. Singh also has a master's in economics from Central University of Himachal Pradesh and a bachelor's of commerce from Himachal Pradesh University. With a strong academic and research background, he is committed to advancing economic theory and fostering analytical and critical thinking skills in his students. We welcome you, sir, on behalf of BVA and looking forward to your insights on valuation. Over to you, sir.
Thank you so much, ma'am. Good morning, everyone. First of all, I would like to thank Neeraj sir for giving me this opportunity to speak in front of you. Am I audible? Hello?
Yes, sir.
But you are not visible, sir.
Okay, sorry. Am I visual?
Yes, sir.
Okay, so thank you so much. Today's topic is the panel data and the analysis of panel data. So how it can help us in understanding different type of data sets, specifically the panel data models. I will be focusing on how to understand that various determinants or the factors that can impact the valuation of different companies or maybe different investment avenues. So that is the broadly the theme of today's topic. So I will be sharing the PPT. Is it visible to you all?
Yes, sir.
Thank you so much. So that I have given the title as Beyond Valuation because once we have done the valuation, but we can further do with that data set. So for example, if we have the valuation for time series data on valuation for different companies or one particular company, after that, what we can do with that data. So that will be the main thing which I will be focusing more on this thing. So the content of today's presentation will be like, I will give a brief introduction and then after different type of data set which we discuss in econometrics analysis. Specifically, if we have cross-sectional time series or panel data, then how we fit a model and how we interpret those data. Then after I will be discussing stata. I hope most of you will be aware of this statistical tool, which is widely used in econometrics to understand various dimension of a data set. Then after that, I will be specifically discussing the factor that impacts the valuation of different companies. They may be company specific or industry specific, or maybe the macroeconomic indicators that might have a bearing on the valuation of different companies. Then after we will jump into framing the model, how we put the data into a more panel data model. Some discrepancies also we're discussing, like outlier and the data transformation issues. Post that, we will be interpreting this panel data results. Then after I will conclude. So I will continue. So basically, we rely on multiple methods to value the different companies or different investment avenues. Like we rely on book value method or market value method, or there are numerous methods on which we rely to understand the valuation of different companies or maybe different investment avenues. So once we know, so the other steps could be to understand that how to, say, for example, if this valuation of the company is moving across the years, then how we can identify that which are the factors responsible for those things. So for that, we can rely on these techniques, which specifically we will be discussing panel data models. So broadly, if we speak, what are the factors that can impact the valuation of companies? That will be, say, for example, company spec broadly, they can be categorized under four heads. So those are company specific factors or industry specific. Some macroeconomic indicators might also impact the valuation of companies. And then after some exogenous events like, say, for example, global financial crisis happened, or maybe COVID-19 or other like introduction of GST or demonetization, such factors comes under that exogenous factor. So those are the factors that can impact the valuation of the companies. So how we frame that into a model that we will be discussing in the further slides. So broadly, these data sets can be divided into quantitative and qualitative data factors, but here our focus will be more on the quantitative factors so that we can segregate the impact of these set of indicators on the valuation of different companies. So broadly, as I was discussing, the data in econometric analysis, we divide into broadly three themes, three heads, that is cross-sectional data, time series, and panel data. So in cross-sectional data, I will show you one, if I can share an Excel sheet. Can you see Excel sheet? Hello.
Yes, sir.
Yes.
Is it okay? Okay. So this is a hypothetical data which I have created. So this data set is belongs to the automobile industry, and we have data set. The time ranges from 1999 to
Sorry, sir, that Excel sheet is not visible. The PPT is visible. I think you have shared your screen, not the. You need to share your entire screen.
can I share this file with you so that you can share it?
I think two people will not be able to share it simultaneously. So if you are sharing your screen,
Okay.
you have, I think, selected only your. You have to select your entire screen for sharing.
Okay. Can you see the?
Now it is visible, sir. Yeah.
Yes, sir.
Okay. Okay, so this is a hypothetical data which I have created to just show you different types of data set which we might have to for our analysis. So this is the data for automobile industry for different companies starting from 1999 till 2022, and the different companies, say for example Maruti Suzuki, Volkswagen, Ford, Honda, General Motors, BMW, and so on. So I have data on these indicators. So if we talk about the cross-sectional data, then that implies, say, for example, if we have data on one particular year, say, for example, 2022, and that data set is for different companies. For example, I have data for different companies which I am discussing for one particular area, that is cross-sectional data. So for that, we can rely on different techniques like ordinary least square that I will be discussing further. But today our focus is on the panel data, where the panel data implies that, say for example, if we have data on all the companies, different say automobile companies, and then after we have data on different years of the year. So say for example, this data set is a panel data where we have time dimension as well as the cross-section dimension, which is this thing, different companies automobile industry. So So this is the kind of data set which I will be discussing whenever I'm discussing with respect to the panel data modeling.
So when you say cross-sectional data, what do you mean exactly?
Okay, so
And just requesting you that just slow down a bit, sir, because it's a topic that is very you must be very no knowledgeable about, but we are not having that much knowledge.
okay, okay, okay. Broadly, these are the three kind of data sets: cross-sectional data, time series, and panel data. Why we segregate this data set? Because the techniques which are applied on different data set are differs. So the techniques which are applied to panel data cannot be applied to the cross-sectional or time series. Or if we apply, the results which we will be getting will not be telling you the true story behind the data sets. So that's why we segregate the data into different types like cross-sectional, time series, and panel data. So the first is cross-sectional data, which implies that, say, for example, I have data on, say, for 2022 year, the recent year, say, for example, 2024, if I have data on one particular company or maybe five of different companies for one particular year, or different indicators, they're ranging from market share, debt to equity, consumer confidence, inflation, and interest rate. So if I have data on numerous indicators for different companies for one particular year, that is cross-sectional data. Is that clear?
Yes, sir. Yes, sir.
Yeah. Yeah. Then after, say, for example, if I have data, say, I have a data on one particular company for different years. Say, for example, the first you say the cells which I am selecting for Maruti Suzuki are starting from 1999 till 2022. So if I am taking this data set for one particular company, then it is a time series data. After that, say, for example, I have different years starting from 1999 till 2022, but I am the cross-sectional identity, which is different companies, that is also varying. Means I have data for different companies for different years. That is the panel data. That is our main focus of today. Say why we take the panel data, because it captures different effects. Because say, for example, we have different companies ranging from Maruti Suzuki to Volkswagen, for different automobile companies. So the thing is, some say regulatory norms are introduced in a country. Those norms will be impacting all the companies simultaneously. Or say, for example, one company is increasing its market share, then after it will impact the other company's market share as well. So that's why, in order to capture those impacts, we need to have a data set which have all these characteristics. So that is why the panel data is very much useful compared to other kind of data sets. So that's why I have picked this topic to discuss that how, say, for example, if we have the panel data set, how we can segregate the impact of different variables on the valuation of the company. So I will move forward. So these are the different types of data sets. So specifically, we will be focusing on this panel data and how we segregate the impact of different indicators in case of panel data models. So Stata, which I was discussing, is a statistical tool which is used to analyze different type of data set, whether it is cross-sectional, time series, or panel data. But it is very much useful in case of panel data because we can do lots of permutation combination with the data set we can use. Say, for example, we can, if we want to change the data into, say, for example, log form, or generate some other want to do some bootstrapping with the data, or so many data visualization tools are available in this particular statistical tool. So so this is the interface of Stata. Can you see this?
Yes, sir.
Yeah, this is the interface of a statistical tool or statistical software known as Stata. So here it provides so many avenues to understand different dynamics of data sets. So I will be showing you how we uh, upload the data into this, and then after how we apply basic techniques to understand the panel data model. So this particular software allows us to understand how, if we can manage the data. We can, say, for example, if I want to draw various graphs, or I want to test various hypotheses, I want to forecast some data, say for example, I want to forecast the valuation of companies for next 5 years. So how it is going to change over next 5 years. So if I want to do that, this particular software will allow us to do all those things. Moreover, say for example, I want to test, if the debt to equity ratio is going to impact the valuation of a company or not, or say for example, if some particular regulatory norm is introduced, then how it is going to impact the valuation. Will it impact, or will that impact will be statistically significant or not? If I want to test all those things, then I will rely on hypothesis testing, which is also available in this particular software. Although there are other software as well, like eViews, Stata, then R we can also use to understand these kind of dynamics, but it is very quite convenient to use this thing, Stata. So the next thing is, what are the factors that can impact the value of a company? So I have put here some of the factor which is coming out from the literature. So I have reviewed few of the studies which shows that what could be the factor that can impact the valuation of the company, because whenever we are entering some data in the software, it will give some results. But ultimately, we should have some theory to spot those, say for example, a data set, that why we are including all those things. So I have taken this thing from the literature, which shows, say for example, the market valuation of this valuation of a company relies on, say, market share, how its revenue is growing, what is its return on assets, what is debt to equity ratio, weighted average cost of capital. Then other indicators, some other indicators could be like, uh, how much is the capital expenditure, then after how much it is investing on the research and developments. Moreover, the other factor which will be impacting that particular industry itself, that is industry PE ratio. Then after, some of the others macroeconomic indicators which can impact the valuation of the companies might include how the inflation prospects are changing over the years. Then after, how the GDP of a country is changing, or if, say, for example, one particular company is engaging in international trade, generally that is the case, then how the exchange rate of the country is going to impact their valuation. So all those factors that can impact. So our main focus is how to segregate the impact of all these factors, and to understand that, say, for example, if the GDP of the country is going to increase by this much, how much change we can see in the valuation of a company. Or say, for example, if the debt to equity ratio is change of a company, or is changing by this much, then how much is going to be the change on the valuation of a company. So that effect we want to segregate, and that that we can do using the panel data models. So all these indicators are coming out from the literature. Then
I'm also sorry to,
Yeah.
I mean, everything else I'm aware, but the one, what is independent variable? What is its role in?
Okay, sir, I will be
Yeah.
I will be coming into the model. Then I will discuss this thing in detail, that what is dependent and independent variables in the coming slides. It's there.
Okay. Thank you. Thank you.
Thank you. So before entering the data into any model, we need to understand some of the data discrepancies, or we cannot directly pick the data and put into, because there might be some issues like outlier issues, or maybe the multi-collinearity is the issue. I will discuss this thing also in the coming slide, that if these kind of issues are there, then putting the data directly into model, it will give you results, but those will not be reliable results, or statistically validating those results will not be possible, or they might give you results which are quite opposite to the theory. So those are the things. So first of all, say for example, if our data have the outliers, means some of the values are quite extreme. Say I have given the data of this thing, automobile industry. So say for example, one of the companies a outlier having extreme values with respect to different indicators, then including that company will impact the result at the aggregate level. So if that is the case, then we need to do something with that data set. So for that, what can we do? So there are different methods to deal with the outlier issues that we can do. The first thing is we can do the sensitivity analysis. Say, for example, first model you will run when you will keep all the variables as it is. We won't change the, say, for example, one company is extreme or something. So we will keep like this, and other model we will run by excluding that particular company. So, and then after we will compare the results. So if that is significantly impacting the results or the coefficients which we are getting, then we need to remove that particular company. Or if we can't remove, if we have limited data sets, then we can apply other techniques like z-score method is there, which help us in removing some of the extreme values, or the winsorization method is there. That means we set a threshold, and if some values are crossing that particular limit, then we can replace those values with the nearest maximum or minimum value. So there are some of the methods which can be used to remove the outlier, so that their effect can be reduced. And multicollinearity and endogeneity issues, that means, say for example, we have taken some independent variables, say debt to equity ratio and return on asset. So if we find that there is a high degree of correlation, positive or negative, whatever it is, if it is there, then the whatever the results we are getting, that will not be the true coefficient of that. Means the value, the coefficient of debt to equity which we are going to get, or say for example, uh, return on assets, that will not be the true coefficient. In that case, we need to pick only one variables which can explain, because both of them are telling the same story. So that is the thing which we can discuss, and find out that which variable we need to go through. In that case, we can rely on the literature and find out that, okay, so broadly, if one particular variables can inculcate or control for all other factors, then we can include that particular variable only. The other thing is endogeneity issue. Endogeneity means, say, for example, sometime what we do, uh, uh, if I want to see the valuation of company, I also include the valuation, its previous valuation, to predict the current valuation of the company. So, for example, the last year's valuation is going to impact the valuation of the current year. If that is the case, if I am including that variable in our model, then that will uh, generate or create a issue which is known as endogeneity issue. So for dealing with that, there are different models which we need to rely upon. We cannot directly use the simple panel models like which we will be discussing in the coming slide. So we cannot directly use. So there are some other issues as well. So for the timing, I thought I will be discussing only these issues with the data. Although there are other issues which are not of prime concern for panel data, like autocorrelation issues there, that is specifically with respect to time series, but these still we need to check for all those issues as well. So then after once we have done, we have dealt with these issues of outliers and multicollinearity and other things. The other thing which we can do with the data is data normalization. Say, for example, if our data is varying quite much, and we want to put a range, so that our variables, particular variables, should range between that only. So there are different methods which we can rely on, and we can change the range of the valuation. Say, for example, if my data is ranging from 1 to 1 lakh, I can bring it to 0 to 1 by using statistical normalization, so that the data will vary only between 0 and 1. It will be easy to interpret. But generally, we do that in case of if data is variability is very much. And the other things which we can do is we can convert that data into a log form. So data, we can change the data into log, or we can take the square. So that depends upon whether by changing that thing, the issues of say, for example, variability and all is gone or not. So those things which we can test. So now I will discuss specifically the model framing in panel data set. So here, so this is a simple panel model where I have taken the company valuation or value of a company as a dependent variable. So the dependent variable is the variable which is dependent on some other variable. Say, for example, here you can, if you can see, the company valuation, which is in the left hand side, is dependent upon these four vectors, which is company specific variables, industry specific variables, macroeconomic variables, and other dummy variables which can impact the valuation of a company. So as I was discussing, some company specific variables may be the profitability, how the profitability is changing, what is happening to the debt to equity ratio, then after what is happening to the liquidity, what is happening to the say for example goodwill of the company, or numerous indicator which will be specific to that particular company. Then after the other vector, the second vector talks about the industry specific factor. So the factor which are going to impact not only that particular company, but also the other companies which are operating in that particular industry. So for example, I was giving the example of automobile industry. So say for example, one rule is coming, so when a law is passed, that will be equally applicable to all the firms working that particular industry. So if that is the case, that is a industry specific variable. Or the other could be, say, for example, the how much market share a particular industry is having. So if one particular company is having some share, that will impact the share of others. So that is a industry specific factor. The next one is macroeconomics. So all the companies they have to work within the economy, and the economic factors like how the GDP is changing, inflation is growing, then after how the exchange rate is changing, stock market capitalization. These are some of the macroeconomic factors. So these that can impact the valuation of the company. So these are the independent variables. So whatever we are seeing in the right hand side, different four vectors, these are the independent variables that can impact the valuation of the company. So I hope the dependent, independent, this concept is clear.
So when you say independent and dependent, there is some sort of you give weightage to something more. Independent is given weightage more, or like
Yeah, sir, when I will be running this model, that model will take care of that how much weight we will be giving to the one particular, say for example, company specific variable or industry specific variable. So say for example, whatever the coefficient which we will be getting, that will tell that how much impact one particular variable, whether it is industry specific or company specific, how much impact it is having on the valuation of the company. So that will be the weight of the company. So the coefficient value will tell us that how much it is impacting the valuation of the company.
okay,
Then after the last fourth variable is the dummy variable, which is exogenous variables, as I was discussing earlier as well, that say for example it might be global financial crisis or any other exogenous event which happened during that particular data set which we are exploring. So for example, if we have to explore the data which I have discussed here, I'm discussing. So say for example, in the years 2007 to 2009, there was global financial crisis, or maybe 2021. We can say that there was some say COVID-19 or some GST was introduced, or say demonetization was introduced. So because of that, that might have some impact on the valuation of the company in the longer run. So if that is the case, then we have to segregate that impact. Otherwise, that impact will not be captured, or that will, so whatever the coefficient we will be getting for other variables like industry specific or company, that will also, or the error factor, which is we are including, will include that factor. So that is why we have to, if say, for example, some exogenous event is happening, then we have to introduce this into a model so that our other coefficients are not impacted. So, this is a model that we run, and through which, after running this model, we try to understand that how it is going to impact the valuation of the company. So I will show you a simple model. I will run a simple model, and we will try to understand the results of that particular model. So say for example, first I will run a model, a simple model, which is known as pooled OLS. Uh, so for example, for that we can simply run that model in the Excel, or then after I will be showing you how to run a panel model that I will be doing in this data. So for that, in Excel we can go to the data. in the data analysis, there is a data analysis tab. There we can go to the regression analysis. Okay, so now here in this box, we need to specify that which particular variable is dependent on which particular variable. Say, for example, what are the dependent and independent variables in this case? So in this case, in this particular hypothetical data, I have taken dependent variable as the valuation of the companies. So how the valuation is being impacted by different particular indicators. So the input by range specifies the dependent variables, mean which is dependent on the others. So here I will select these dependent variables. Then after it is asking for say input X range. X range means the independent variables which are impacting the which can impact the valuation of different companies. So I will select all the variables. So these are the independent variables which might impact like market share, debt to equity, consumer confidence, inflation rate, interest rate. Although we can include numerous variables depending upon whether it is quoted in the literature or not, but I have taken only these variables. This is one thing, this is hypothetical data, so it might not give results as per the theory. It might contradict general understanding, but this is a hypothetical data just to show how to run this model. So after selecting this dependent and independent variables, we decide the confidence level. Means, say for example, when we will be getting the coefficient of different independent variables like market share, how market share is impacting the valuation or these things. We want to see that how much confident we are with the coefficients, whether how much confident statistically we are confident that our coefficients are not random, they are not coming by chance. So after that, I will click OK. So we will get results like this. So we will get a table of results like this here. So now I will be showing to how to interpret these results. So here, say for example, can you see that this table which I am selecting here?
Yes, sir.
This is the main table which we will be interpreting, that that will be segregating the impact of different indicators on the this dependent variables. So before getting into that, there are some preliminary checks which we need to do before interpreting these results. The first thing which we look at is the F statistics, which is here. This thing, can you see the F statistics? Now this is the F statistics, which tells us that whether our overall model is significant or not. Means whatever the variables, independent variables which we have taken to explain the valuation of the company, are they explaining the variation or not? Okay, so if the F statistic is significant, means if the value of F stat, the P value, this is known as significance value, if this value is less than 0.01, P value, if it is less than 0.01, that means we can say that our model, statistical model, which we are looking into, is statistically significant. That means at least one particular independent variable is statistically significantly impacting the dependent variable, which is the valuation of the company. So we cannot say that there is no variable which is going to impact this particular our dependent variable. So in this case, the value is 0 or less 0.001 or maybe less than 0.01. That means our model is significant. Okay. That means at least one particular variable will be impacting the dependent variable, which is the valuation of the company. So the other set of variables, now after interpreting the F statistic, then we can move ahead. Say for example, if this statistic is not significant, then we'll stop here, that our model is not significant. We need to introduce other variables in order to explain the variation in the valuation of the companies. We cannot say for example, if this value is coming out to be more than 0.1, then we will say that this is not at all significant model, and we need to introduce some new variables, or maybe we need to drop some of the variables which are not explaining the valuation of the companies. So once we interpret the F statistics, we get to know that, okay, here this model is significant. Now we can move to the other statistics, that is R square and adjusted R square. So this is R square and adjusted R squares. So the R squares will tell us that whatever the variables we have taken in the model, say for example, market share, debt to equity, consumer confidence, inflation, and interest rate. So how much variation in the valuation of the company is explained by these variables, these 5 variables? So here in this case, R square is coming out to be 80.80, means 80% of the variation can be explained using these variables. Then after, uh, uh, we see as the adjusted R square. First thing is R square, then is the adjusted R square, which tells us that if we say for example, if we adjust for the degree of freedom, means how much freely these variables can move. If we adjust for that, this adjusted R square still coming out to be 79, 0.7, and that means 79% variation in our valuation is still explained by these 5 variables. So these are the first 2 statistics which we look at before we interpret these coefficients. So if these coefficients are fine, so for example, if this value is 0.10, if say for example this value is 0.10, that means only 10% of the variation in the model is explained by these variables. So generally in social sciences or management sciences, we see if the model is explaining more than 70% of the variation, then we consider that as a good model. Otherwise, we try to find out new variables which can explain the more variation in the model.
So, just 1 second. So, if you say that it is 10%, that means you need to add more variables in order to see what would be the impact and which actually has an impact on valuation, correct? No?
Yeah, we need to introduce some more variables.
New factors.
Yeah, new factors. So say for example, these variables, whatever I have as market share, debt to equity, these are explaining only 10% variation. So, up to 10% variation in the valuation is explained by this. But our aim is to have more factors that can explain at least substantial variation in the valuation of the company. So
Okay.
in that case, we try to find out some more variables, or maybe we can introduce some macroeconomic indicators which we might not have introduced in the model, or we need to find out some other variables basically to understand, so to increase this value of R square. So
So, sir, does it actually mean that if there is a 10% variation, and does that mean that the data set is not reliable?
No, the data, that means the variables which I have taken is just explaining 10%. We can't say it is not reliable. It is explaining some variation. But the thing is, our purpose is to understand the substantial variation. Only 10% variation is showing the change. So if we want to find out the variation which is more than, say, for example, 70% variation, if we can explain. So if we can explain, then it will be easy to take some decisions. So for example, we can say, for example, I have 5 variables and those are explaining 80% of the variation. That means by doing something on these variables, I can change the valuation of the company.
And
So
if you were to modify the variables, then the variation will be less. There will be lesser variation. I think if you were to change the data sets, if you are, is my understanding correct, sir?
Variation might change, but the thing is how much variation, whether it is explaining more variation or less variation. Say for example, I am say for example, here I have introduced interest rate, I'm introducing GDP here. So GDP of the country is also going to impact the valuation directly or indirectly. So say for example, if I introduce this one and this R square value is getting to be 85, that means by introducing this variable, the explanatory power of the model is increasing. How much
Okay, sir.
variation in the valuation is being explained by model is increasing. So that is a good thing in the model. So this is how we can interpret this thing. The other thing is now, okay, so once we are clear with this first two checks, that is F statistics and R squares, then we go into understanding these coefficients. So the
Sir,
important thing,
with your permission, should we launch the first poll question or should we wait?
yeah, we can I just finish this?
Then just let me know, we'll do it.
Okay, okay,
Thank
so I'm just highlighting these variables which are of interest for us for the timing. So again, so here I have 5 variables, and here are the coefficient. We want to interpret the coefficient. Now the question which sir was asking, that how we bait, which one is going to impact, which particular variable is going to impact which particular variable, and what is going to be the bait of that thing. From coefficient we will get to know that how much it is impacting the things. So let me be very clear once again, this is a hypothetical data, so this is not the real data. So whatever the results we are getting, which are just hypothetical. So the thing is, what we need to look at here is the p-values and the coefficient. The first thing we look at the p-value. P-value means probability value that these coefficient are not random. So, say for example, in case of statistics, we discussed that if this value is coming out to be less than 0.01 or 0.05, then we can say that this F statistic is significant, statistically significant. If say for similar is the case with the p-value here for the different variables. So if the p-value is coming out to be less than 0.01 or 0.05, generally in social sciences we take 0.05 and we go ahead with the model. So if this value is coming out to be less than 0.05, then we will say that that particular variable is statistically significant. That means that particular variable is having a statistically significant bearing on that particular dependent variable, which is valuation in this case. So say for example, here the first variable is market share. So the p-value is less than 0.01. That means market share is significantly impacting the valuation of the company. Similarly, say for example, the other variable is debt to equity is also impacting statistically significantly the inflation, interest rate, but this consumer confidence is not coming out to be impacting the variation or the valuation of company in a significant way, because this value is more than 0.1. So this value should be less than 0.05. Then only we will interpret the different coefficients, these coefficients. Sorry. So and the other thing is, this is the intercept. The intercept tells us that if these other, we are not considering these variables, then what will be the valuation of the company. So once we look at the p-values, if the variables is significant, coming out of significant, then we can say that this particular variable is explaining the variation. So how we interpret? So okay, so now we can continue with the question. Then after I will discuss the interpretation of these coefficients. Sorry.
Is the poll question visible, sir? Sir, poll question is visible now?
Yeah, visual.
Yeah. Please participate, everybody. Okay. So I think more than 50% people have participated.
So can I go ahead or?
Yes, sir.
Okay. So
So will we get to
sir,
know the
one-
answer
one-
now or later at the end of the session for the poll
Later.
questions?
We'll share it.
Sir, one point, as you have said, significance of F should be not more than 0.01.
yes, sir.
Similarly, the p-value should also be 0.01.
So this significance is specifying the p-value only. This significance here, I'm talking about this F statistics. This one, just a second. This significance is telling the p-value only. This is the p-value of F statistics. Here, this p-value of these coefficients. But here, this p-value is of F statistics. That this,
Okay.
yeah. So this value, ideally, if it is less than 0.01, that is very good. But if it is less than 0.05 also, that is considered in the social sciences. We consider that as a good indicator that this F statistic is significant.
Okay. Then in the intercept also the p-value is coming from the significance of F.
Yes. No. This intercept value is coming out to be not from the F significance of F statistics. F statistics is telling us about the overall model.
Okay.
So whether overall model is significant. What does overall model means? That means at least one variable which we have picked in the in our model, at least one variable is significant. We can't say that out of these variables, 5 variables which we have taken, there is no variable which is significantly impacting.
Okay. So it should be below 0.05.
If below 0.05, then it is acceptable.
Acceptable. Then simultaneously, then we have to see the p-value. It should also be less than 0.05.
Yes, it should be less than 0.05.
Oh, okay. Got it, sir.
Thank you. So the next thing is, once we get to know these things, now we want to interpret these coefficients. Although these are coming out to be random things, but here few things which we need to, as this is a simple model which I have run on Excel. Here I am not making any difference between different companies. I am considering them as one company, and I'm just clubbing the data and putting it to a model, and then after running. I'm not making any difference between, say, for example, I have Maruti Suzuki that might have different market share or the different company. For that, we need to tell this particular software analysis that there are different companies involved in these things. So consider different indicator based on that, and then you give the coefficient. So this is a journal model which is just clubbing all those things and giving us the model. But now we will jump into the panel data model, which will then we will be telling the software that these companies are different companies, and run the model accordingly. Then after we will interpret the results. So here I am into this data. There I am going to import the Excel sheets, the same Excel sheet which I am showing this data set. So this I have uploaded the data into this particular tool. Now I want to see how my data looks like in this first. So for that, the command for that command is browse. So here I can see. So this is the data ranging from 1999 to 2022 for different companies, and I have data on different indicators: company valuation, market share, debt to equity, consumer confidence, inflation, and interest rate. So here I have to identify different companies differently. I need to have something so that I can identify. So this is a string variables. It's not a numerical. So Stata can't understand this thing that, okay, so it can't differentiate. So I have given company code, C code here, so that it can distinguish that one means Maruti Suzuki, two means Volkswagen, and similarly I have given codes to different companies. So now, once I have given the companies code to different companies, now I can give some command and tell us that treat them differently based on uh, how they are going to impact the valuation differently. So here, so now first I will tell this data that this is a panel data, so treat them accordingly. So for that, the command is xtset. X stands for different companies. T stands for different times. So as we know, the panel data includes different cross section at different times. So I'm telling xt, then command is set xt set. So here the x, how the x will be this thing uh, will be identified is C code, which I have given as different codes so that it can identify different C code. And then after I have given this thing as uh, for time dimension, I have given this thing year as a name. So I will give it as an year as this thing, the time series identity. So xt set, so C code means different company, years mean different years. So as I put enter, it tells us that it is a panel variables and it is a strongly balanced because all the data I have done, I have filled hypothetical data on the variable. So it is telling us that it is a strongly balanced panel. Okay, so once that is done, then after, now we will run the model and we will try to understand that how it is going to impact the valuation. So for that, for running the panel model, the basic command is xt, that means this cross-sectional dimension and time dimension. Xtreg, reg means regression model. So xtreg, then I will put the dependent variable first, which is the dependent variable in our case. That is the this thing valuation of the company. So from here, you can see in the right hand side, the variable list is here. So I will put as valuation of the company as the dependent variables, and the variables which are going to impact this thing include the market share, debt to equity, consumer confidence, inflation, and so on. So now after I will run the model, put enter, then it will give us the results like this. So similarly, which I was telling you earlier, that how we interpret these results. Now, so instead of F statistics, we will get the Wald chi, which is also similar test in case of to understand the overall significance of the model, which is presented here. This one, the Wald chi. So now we will look at the significance p value of this thing, which is coming out to be 0.00. That means our model is significant. At least one of the variable is significantly impacting the dependent variables. Then after looking at this, we will look at the R square value. R square is coming out to be higher compared to what we were discussing in the earlier slides, where it was showing out coming out to be here, it was coming out to be 785, 85. That means if we differentiate between different companies, then the predictability of the model is increasing. So that means we should differentiate, because different companies are having different strategies, different set of environment in which they are operating, and all those things will come. So their impact will be different variable will be impacting them differently. So then after, so now I will interpret these results. So for example, I have kept similar data results here. So first, what we do, so this is for the ordinary model here. So for example, first, if we are running the panel model, we will get the Wald chi. For that also, we need to look at the p-value. If that is significant, that means our overall model is significant. Then we look at the R square and adjusted R square, how that is, whether it is explaining significant variation in the model or not. Once that is clear, then we jump into these coefficients, different coefficients, which explain the variation. So now first we look at this p-value. Can you see the cursor? I'm moving.
Yes, sir.
Yes, sir.
So first we look at this p-value. Once these things, the F statistic and R square is done with, then after we look at these p-values. If say for example here you can see, although this is a hypothetical data was showing all the variables are significant. That means all the variables are having significant impact on the valuation of the company. Although that can also be a if such kind of results are coming, then we should be suspicious whether some issue is there, maybe multi-collinearity and some data issue, outlier issues are there or not. But still, And the other thing is, if the R square is coming out to be very much high, then also we should be very cautious. Maybe some issues might be there in the data, maybe outlier issues, or maybe some missing data issues, or some issues might be there that because of that we might get some extreme values or extreme results. So sometimes it might be too good to be true in results might be like that. So we need to be very cautious. So once the variables are significant, then we can say that, say for example, the first one is revenue. Here, this is another example of the variable where the valuation of the company is dependent upon revenue, profit margin, industry growth, GDP growth, interest rate, debt to equity, and all those things. So say for example, first independent variable is the revenue. So if we have measured the revenue in absolute numbers, say for example, it is in, say, absolute numbers, say for example, this much revenue, say in absolute number, in say for Indian currency, if it is in absolute number. So how we will interpret this thing? This will tell us that if the revenue changes by 1%. So if it is an absolute number, then we will interpret it as that if revenue changes by 1 rupees, this thing, the dependent variable, which is the valuation of the company, is going to change by 85 paise. Is that clear? So if the revenue is changing by, if it is in absolute number, if we have taken the variables in the absolute number, both valuation as well as the revenue. If it is in percentage, say for example, it is a growth in revenue, then 1% change in the revenue growth is going to be having 0.85% change in the valuation of the company. Are you with me? Or should I explain once again?
Sir, if you can just repeat once more.
So the thing is, say for example, I'm interpreting the first variable, which is the revenue. Means, say for example, if this revenue is in percentage growth, so how much revenue is changing over the years? If it is in the percentage terms, then how I will interpret this coefficient? I will interpret as if there is a 1% increase in the revenue of the company, it is going to impact the valuation of the company by 0.85%. And this relationship is positive because the coefficient sign is positive. In case of interest rate only, we are having a negative sign. Otherwise, for other variables, we are having a also this debt to equity is having a negative impact on the valuation. Other variables are showing as positive impact on the valuation of the company. So say if the revenue is increasing by 1%, it is going to have positive impact, means that valuation of the company is going to increase by 0.85%. So similarly, I'd say, for example, if the GDP, which is also coming out to be significant, less than 0.01, if that is the case, that means if the GDP of a country is going to increase by 1%, the valuation of the company will increase by 0.70%. Getting this thing? So this is how we interpret different models. And once we interpret this model, then we can find out that, okay, so if we want to forecast something or we want to test the hypothesis that okay, so we are having a hypothesis that debt to equity is not having an impact on the valuation of the company. If we have a hypothesis, now if we want to test that by using this model, we can test if the variable is coming out to be significant, we can reject that hypothesis, that whatever the hypothesis you have taken, which is saying that there is no impact of debt to equity on the valuation. So if it is this p value is coming out to significant, then we can say that your hypothesis is rejected. So debt to equity is having a significant impact on the valuation of the company. Similarly, by using this model, we can say we want to forecast, then we can forecast. Say for example, if these are the variables, and these are the variables, and we have the data on the valuation. We have the data on valuation. So for example, in the next year, the coming year, by filling the value in these coefficients, these coefficients, we can find out that what is going to be the value of valuation of the company in the next years. So this tool can be used to forecast the valuation of the company. The other thing is that here we have taken only this valuation of the company. We can take numerous other variables which we want to predict. Say, for example, I have focused on this valuation because most of the audience uh, is from the valuation. So I have just taken the example of this thing. But say, for example, I want to predict the profitability of a company, or say other variables like, or in economics, we take, say, for example, what is going to affect how the GDP is going to change over the years. So we will put that thing in the dependent variable, and we would try to find out different variables that can explain the GDP of the country or any other variables. By putting that thing in the model, we will get the coefficient. So if the investment in the economy is increasing by 1%, it will have this much impact on the GDP of the country. So by looking at those coefficients, we find out that, okay, so if we can change the investment in the economy, or the private investment or the government investments by 1%, our GDP of the country will increase by this much. If the inflation in the country is increasing by 1%, how much impact it is going to have on the GDP. So this is how we can run different models. So this was the simple model. Although if, say, for example, we have some data issues, as I was discussing some endogeneity issues there, then other models uh, which we can rely on the panel, this thing like system GMM and other models are there, which is not the concern of today's this discussion, but that can be used if our data is having certain issues. Moreover, say, for example, the extension of these models is the non-linear models. Say, for example, there can be the case that we assume that up to certain level, debt to equity is impacting in certain way. After that, it is impacting in certain way. If that is the case, here in this kind of model, we will get only one coefficient. It will tell us whether it is positively impacting or negatively impacting. But if it is the case that debt to equity up to certain level, it is impacting negatively or positively, or after that it is changing to negatively, it is impacting the valuation in negative way. In that case, there are other models known as threshold models, which will give us different coefficient for different age. Say, for example, up to certain level, if the debt to equity ratio was up to this level, whatever the ratio was, then it was impacting valuation in certain way. So those kind of models we can run using threshold model, and we can segregate the impact of different independent variables. So with this, the interpretation is over. If anybody is having query with respect to interpretation, you can ask, please.
Sir, the similar interpretation can we make from the Excel sheet, or we have to take the help of Strata?
Okay. Sir, in Excel, we can run only simple models. So for the timing, there is only simple pooled OLS, pooled OLS model which we can run. But for running these things, these models, we have to rely on other tools which allow us to deal with the panel data model or time series models.
Okay.
Or maybe we need to check. I have not checked. We can check for other add-ins which allow us to deal with some time series or panel data. I'm not sure if it is there, but generally we use the Stata or EBUs to analyze these data sets.
Okay. Thank you.
Thank you. So with this, I conclude the presentation. So the panel data or any other data set can, if we are analyzing using some model, we can understand that how it is going to impact, or what is the contribution of different indicators in impacting the dependent variables. So in this case, it was the valuation. So we can segregate the impact of different variables, that how they are going to impact the dependent variables. So similarly, we can categorize those variables into different heads, like this company specific variable or industry specific variables, or macroeconomic and other dummy variables. By segregating the impact, we can better target those variables. So say, for example, by understanding these variables, we know that if the valuation of the company to be increased, then after we need to target these particular variables, because those variables have a significant impact on the valuation of the company. So now we have a statistical evidence that, okay, by looking at those variables, we can impact the valuation. So by segregating all those things, we can better target the issues which are impacting the valuation. The other things, the non-linear models, which was not a part of today's discussion, but those variables can be used if we think that this the relationship between dependent and independent variable is not linear. It is non-linear. In that case, we can use. And the other thing is this data set can be very much helpful in understanding in accepting or rejecting the hypothesis or testing the hypothesis. Like if I'm having any hypothesis regarding my dependent or independent variables, by using these techniques, I can accept or reject the hypothesis and validate the hypothesis using this statistical tool. And moreover, if we want to forecast that, okay, how this trend is going to change over the years, then with reasonable credibility, we can use these data sets and predict the valuation or any other dependent variables. So these are the references for this presentation I have relied on. With this, thank you very much. If you have any query, you can happy to take questions. Thank you.
So, I have one query. So this is with regard to when we are looking at what do you call industry level database, we want to see which is going to impact.
Yeah.
Now, based on this coefficient, I will know actually which factor triggers the valuation of the particular company in the particular industry.
Yes.
Now, this is like an input for me when I say, for example, I'm using this data to construct the valuation model of my own company, which is working in that sector. So, if this coefficient is an input for me to say that my valuation will be impacted by these, and this would result in sort of a sensitivity analysis, isn't it?
Yeah. Yes. It will.
So,
We get.
Go ahead, sir.
So we will get to know that how sensitive our dependent variable, which was in this case the valuation of company, to the independent variables. That if that particular variable is changing, say for example in absolute number or in percentage, if we are assuming certain change, generally we assume that if 1% change is there, how much percentage change or absolute change is going to happen on the dependent variable. That is the main thing in this case.
Got it.
So why?
Now, I have one more question. This is an industry data that I am taking to see what is the impact on valuation in a particular sector. Assuming this same exercise can be done into different parameters of valuation, which is used for constructing a business model. Say, for example, a gross profit of a company or repairs and maintenance or an investment in plant and all that. Even that data can be populated and we can see the regression analysis to see any change in these can result in a change in valuation. And
Yes,
then
ma'am.
we can create a sensitivity analysis around this.
Yes, ma'am. Yes, ma'am. You can incorporate all those variables into the model and see whether those variables are significant, statistically significant for impacting our dependent variable or not. So, for example, as you are telling the gross profit, obviously there will be impact of that thing. So whether that is a significant impact or not, that we can see by putting that variable into this particular data set. The other thing I
Now
want to.
I will. One more thing, sir.
Yeah.
Now I'm extending the analysis to one level further. Now, based on this, how can I find out that one particular variable that I have projected is a little erratic and I need to normalize it? Is it possible through the analysis? Say,
Yes,
for
ma'am.
example, I have a certain revenue stream that I have created. Sorry, I'm taking it to a individual company level now from an industry. But if a company, I have projected certain revenue levels across years. And I have projected certain expense level across years. Now, in order to arrive at a certain valuation, one particular variable has been adjusted a little erratically as against the normal mechanism in which it has to move. Can I find an outlier through this regression model for this?
Yeah, ma'am, for doing the outlier analysis, there are other techniques apart from the regression, because if we are putting that variable into the model, then that will impact the regression coefficient, which we are seeing in this case here, whatever the coefficient we are seeing. So if any variable is having any outlier issues, then if we are putting that into the model, we will get some coefficient, but that impact will be reflected on these things. Maybe these coefficient will be overestimated or underestimated. If that is the case, then these are not the true coefficient. Moreover, sometime what can happen is that if you are using those outlier, the variables which are containing outliers, this p-value somehow, say for example, we get to know that this profit margin is having a significant impact, which is generally understood from the theory. So if it is coming out as significant and you are introducing one variable which is not having which is not normally distributed, or maybe some outlier issues there, then might be the case that this p-value will become insignificant. So the results of other variables will also get impacted because of that. So before entering the data, we need to deal with. That's why I discussed that we need to deal with the data discrepancies that includes the outlier issue. So we can rely on Winsorization or Z-score method that will remove the outlier issues from the data sets.
So that means to analyze the outlier issues, we have the sensitivity analysis, which we populated and get the analysis out. Now, based on then I see the analysis and its impact, and then that means there is a certain bias when I analyze the coefficient where I say that profit is supposed to have a significant impact on the valuation. But because of this outlier, the profit is not. That means my sensitivity analysis is not complete. My outlier is not completely removed. Is it a reasonable conclusion that I can take?
That is one possibility, ma'am. That is one possibility, that it might change the coefficient, maybe the p value, or maybe the case that your f statistics will become insignificant. Although it was significant, by introducing that variable, what will happen that your f statistic will come out to be insignificant. Or sometime what could happen that your R square is coming out to be very high, but your f statistic is not significant at all. That means your model is not significant, but your R square model is explaining too much variations. So both are not consistent. One side you are saying that your model is not significant. The other side you are saying that your model is explaining 80% variation. So if those situations can occur if this outlier issue is there in the model. So it is crucial to deal with these things at the initial stage.
If I want to enhance my knowledge, what do I do?
Sorry, ma'am, you are not clear. Can you repeat that?
This is a beautiful input you have given, sir. If I have to enhance my knowledge on this, what do I do?
Sorry, if you have to
enhance my knowledge on this and get a little more in-depth and I say to how can I acquire this knowledge and my ability to do this kind of activity?
So for that, I have given ma'am one reference book. It's there which will give a brief guidelines. It is a introductory kind of a book which will allow you to understand different type of data set and different type of model which we can apply on different type of data sets. So these books this book you can rely upon, and there are other books which we can rely on to understand this initial data analysis techniques.
This is very insightful.
Sorry.
This was very, very insightful, sir. I got a lot from this.
Thank you. Thank you.
Nirmal sir, what we can do is we can run the poll questions one by one, and then you can just comment on the answer results, like whether they're right or wrong.
Okay, ma'am. Okay, sir. Thank you.
You have launched the second question.
But personally, I think this question ought to be having one more answer to it. Not familiar at all.
So most of the participants are somewhat familiar or not familiar.
Mm, okay.
The third question. Nirmal sir, which method do you find the most effective in your analysis? If I ask the question to you, sir.
So generally, this the first one is used widely in generally in here we in classes also we focus more if we are giving an example of this thing. Generally, this is considered, but you can give me more insights how what is the case in the industries and
Okay, yeah. So I think most of us will agree with that. DCF is the most commonly used valuation method because especially when you are listing, when you are valuing private companies and all, so getting peer data, comparable company analysis is a tough job.
okay, okay,
So that is why DCF is the most uh, used
widely used.
method. Yeah. And I think the precedent transaction is, I think, can be done for more merger acquisition type of activities because it's more transaction based.
Hmm. Okay.
And
Hmm.
ultimately, asset-based valuation, I think some people will agree it is either done mostly when you are in a liquidation type of event or you are doing something of an very capital-intensive type of industry valuation. So it is done. I think people have mostly voted for DCF only.
Okay. Hmm.
I'll just share the results.
Please show the result. Yeah.
So is it visible, sir?
Yes, sir. Yeah. Comparable is coming out to be the second one. Although somehow I believe that this is difficult because finding similar kind of setups across the company is very difficult. So then the valuation can be quite difficult in that case.
Okay. Launching the fourth question. Everybody, please participate. The result for the poll, fourth question, sir.
Okay, so we are getting as the earning growth rate as the most important determinant. So this is what we believe, but in order to validate that thing statistically, we have to put that into the model. Then after we can say that, okay, this is the most significant variable impacting the valuation of the companies. And we can validate that whether our perception is correct or not.
Okay. So this question is more case to case basis, right? Because
Yeah, yes, there is no right answer to these things.
this
Maybe
question.
for some companies, it might be some other variables that might have significant impact.
Okay. The last question of the day. So
Oh,
I think mostly it is on the rarely side. But I'm surprised that nobody has selected never also, because when you are doing DCF valuations and all,
mhm.
uh, people they take the projection, but how much they are impact, because when you are estimating doing some sort of projection, how do you take the impact of macroeconomics in those projections, because you don't have idea that what will happen in the future in a macro terms. Probably
Yeah,
the company can have its own estimate, but how
yeah.
much the projections take into factors of macroeconomics, that is a big question.
Yeah, this is specifically when we are using some model to understand this impact. So, for example, in this case, in the example which I discussed, I used two macroeconomic indicators. Generally, whenever we are fitting any model, it is very much essential to incorporate, because any company is working within the macroeconomic setup of that particular country. So definitely the inflation level, the interest rate changes, or say for example how the exchange rate is changing, that is going to have impact. And I have seen in numerous cases during my research also that these variables have a significant impact. So whenever you are introducing macroeconomic indicators in your model, your predictivity power of your model will increase, and that is well documented in the literature as well.
So I think the poll questions are done. If nobody has any further question, then I would ask Abhishek to give a vote of
Nirmalji,
thanks.
I got one query. Say,
Yeah.
what do you suggest whether to cover the macroeconomic indicators in any
Yes,
valuation report always,
yes, I would
depending on
suggest
the necessity?
I would suggest include the variable. At least you try, at least first you run one model, and there you see whether they are having impact. In certain cases, it might be the case then they are not impacting. Then you can consider dropping them. But first, it is required to test that whether they are having an impact or not. In general sense, in economic theory, it will have certain impact. So testing it, generally, say for example, if I'm sending some research paper for publication, they will ask why you have not included the macroeconomic indicators, because that might have impact, but that will also impact on what is my dependent variable. So if the theory states that it might have impact on my dependent variable, I can't ignore that thing. I have to introduce that thing in my model.
I feel that the same staple food or basic clothing or basic housing, etc., may not be much elastic on the economic conditions. But whereas, say, what do you call precious goods or costlier goods, etc., will have definitely vary according to the economic conditions of the economy. Say in the case of say staple food like rice or wheat or some other, somebody has to necessarily consume it. So it may not be having much impact on the demand or supply, etc.
So the thing is,
Except the production.
so the general thing is we take the reference as the theory, what theory states. If some relationship is already well documented in the previous literature that they have impact on these things, we should include, at least we should test whether they are having a significant bearing on the dependent variable or not.
Nirmal sir, I think somebody has texted that. Can you write the book name, the reference name in the chat box?
Okay, okay, so I will share you the reference of few books with you.
Do one thing also, you can send it to me on WhatsApp also, and
I will share some reference of some books that
yeah,
you can share.
and I'll forward it to in our members group and all.
Okay, sir.
So, any further question, anyone in the participants?
Can this PPT be shared?
Yes, I will share.
Thank
Yes, sir.
you.
Vijaya will share that in the group. So, if no further question, then I'll ask Abhishek to do a vote of thanks for this excellent session by Mr. Dr. Nirmal.
Good morning, everyone. As we conclude this insightful session, I'm delighted to extend my vote of thanks. Firstly, I would like to express my gratitude to our esteemed speaker, Dr. Nirmal Singh, for sharing his expertise and perspectives with us today. Your perspectives has definitely provided us with both foundational knowledge and an idea about statistical approaches, which will definitely influence our work. Thank you, sir.
Thank you so
To
much.
our fellow valuers, thank you for your active participation and for the experiences you have shared. Being among such dedicated professionals is truly inspiring. Let's continue the exchange of ideas and support one another in our growth. A special thanks to our managing committee members of Bangalore Values Association for organizing today's event and creating a space that fosters collaboration and continuous learning. Finally, to everyone here this morning, your engagement and enthusiasm have made this session much more valuable. Wish you all a great day ahead. Thank you.
Thank you so much, everyone. Thank you. Thank you, Neeraj sir, for giving the opportunity. Thank you.
Thank you.
Okay, with this, we are closing the session for today. Thank you all for joining.
Thank you.